Well, good afternoon and welcome back to my video blog. Today I have the honor and privilege of presenting Jason Augustine, who's with the accounting firm Glenn Burdett. And welcome, Jason.
Thank you, Hal.
Yeah, gosh, and I didn't ask you this. I mean, how long has Glenn Burdett? You guys are like a staple in this community. How long have you been around?
They've been around since before my time. So
yeah.
I think all the way back to the 1960s.
Yeah.
And I wasn't around then. I do
Yeah.
have a few gray hairs, but
yeah, you and me both. A little early in our career. So yeah, obviously you guys have a track record. And what we're going to talk about is some timely issues with regard to taxes, how they affect you since it's April 15th is coming up quickly, and how you could potentially benefit and save, thousands of dollars potentially. So one of the things I want to bring up, everybody asks us a lot, is property taxes. Is that something that you can deduct on your tax returns? Can you save? Tell me about that.
Absolutely. Property taxes is a deductible expense as an itemized deduction on your Schedule A on your personal tax return if it is your primary or second home. And if it's an investment home or vacation home, then that's going to be deductible as a investment or second home expense.
Okay,
so
yes, write that up.
Yes, they are deductible.
Okay, good to know. Okay, great. And one of the things, a lot of with the rates being so low, and a lot of our clients buying houses right now, they refinance, and people ask me, well, what can I deduct when I refinance my house, and/or if I got a new loan? So, can you talk a little bit about that?
Sure, and this is a lot. There's a lot of this going on right now, and it is kind of tricky. What we do. When we get a refinance statement from a client is we get the escrow statement, we ask for the escrow statement, and what you're looking for is loan origination charges, and what you're able to do with those is capitalize them and amortize them over the life of the loan. And the other costs that are associated with the refinance are typically built into the basis of the property, which are allowed as a reduce the gain when you would dispose of the property, increase your basis.
Okay, so when they go to sell, they could potentially have less tax liability, kind of.
Yes, it'll lessen the gain.
Okay, good. Obviously, I'm not an accountant, you can tell. So, what are some of the other tax benefits people get of owning real estate, whether it be their home and like a second home or investment property?
Well, you obviously you have the mortgage interest deduction that you get to write off against your ordinary income as an itemized deduction. We spoke about the property taxes. You can take amortization on your loan points, which are, again, a purchase cost of your property. And then there's a special provision for rental or investment properties that allows you to write off up to $25,000 against your ordinary income, provided you're under certain income limitations for a rental or investment property.
Okay, so there's a lot of benefits. Absolutely. And from my perspective, you see that as well.
Absolutely.
So the last thing I want to bring up, and this is somewhat timely, is we have a lot of people now that are doing short sales. They'll owe $400 on a house, it's only worth $300. They sell it, and then what happens is the bank forgives, say, $100,000 of debt. So right now, on certain loans and certain homes, you don't have any liability, but other homes, the IRS is going to want a part of that debt relief, I guess they call it, right?
Right, and I think the important thing, the distinction to make here is that just because the bank forgives the liability on the loan, that doesn't necessarily get you out of the woods with the IRS. Cancellation of debt income can only occur when you have recourse debt on the property. And as Hal was saying, if you have never refinanced the property, if it's purchase money debt, it is non-recourse debt, meaning there's no cancellation of debt income, and you don't have to worry about the IRS coming after you and having you recognize additional income on your tax return. I will say that if you do have a situation like this, you absolutely want to get in touch with a qualified professional, because this is not something that you're going to want to do on TurboTax.
Yeah, and it's not something I'm going to answer as well, so I'll direct them to you. And the main thing is, right now, that was done in 2007. That's going to expire at the end of this year, right?
Correct, Al. That's a great point. December 31st, 2012, the qualified principal residence exclusion is scheduled to expire, and there is nothing set in stone at this point to extend this exclusion past that date. So.
Okay. Good. Well, yeah, so if you know friends that are kind of struggling with this situation, it's somewhat common, and we've had lots of people calling us. give us a call, but it is a time-sensitive issue, and feel free to share this information with your friends or pass this video on, which so many of you have done. Jason, thanks for showing up here. Thanks for clearing up some things for us. And how does someone get a hold of you if they want to reach you and get questions answered about this information?
Yeah, sure. We're at Glen Burdett. We're at 3 locations: San Luis Obispo, Paso Robles, and Santa Maria. We have 3 offices. Our main line is 805-544-1441.
I know that number well. I know that number well.
Thanks for having us.
Yeah, thanks for your time. All right, thank you, and we'll talk to you soon.